You pull into a gas station, swipe your card, fill up your tank, and drive away. It feels like one of the simplest businesses in America. Buy gasoline. Sell gasoline. Keep the difference. But here's the strange part. A gas station can sell millions of dollars worth of fuel every year and still make surprisingly little money from that fuel. In fact, the gasoline itself may be less profitable than the product sitting 20 feet away from the pumps. And that creates a fascinating business model, because a gas station isn't really just a place that sells gasoline. It's a high-traffic retail business built around one of the most powerful reasons a customer has to stop. They're running out of fuel. And once that customer is standing there with their wallet out, the real money story begins. So let's follow the money. Every dollar you spend at a gas station is actually being divided among several different players. There's the crude oil producer. There's the refinery. There's transportation and distribution. There's federal and state government through fuel taxes. And finally, there's the retailer standing in front of you. The retailer is the gas station owner, and the amount left for that owner can be much smaller than the giant number you see on the pump. According to the U.S. Energy Information Administration, the retail price of gasoline is made up primarily of crude oil, refining, distribution and marketing, and taxes. In January 2026, the federal gasoline tax alone was 18.4 cents per gallon, while average state gasoline taxes and fees were about 33 cents per gallon. So if gasoline costs $4 a gallon, the station owner does not get to treat $4 as revenue that belongs to them. A large portion is simply passing through the business. And that's the first thing people misunderstand. The price on the sign is not the owner's profit. It's the beginning of the money flow. Imagine a customer buys 15 gallons. At $4 a gallon, that's a $60 transaction. It looks like the station just made $60. But the station had to buy that gasoline before it could sell it, and depending on market conditions, the retailer might only have a few dozen cents per gallon of gross margin before paying employees, rent, credit card fees, utilities, maintenance, insurance, and everything else required to keep the property operating. NACS says retail fuel gross margins have averaged roughly 38 cents per gallon over the past 5 years, before expenses, and that expenses can consume more than 20 cents per gallon. That means the actual pre-tax profit attributable to fuel can be dramatically smaller than the pump price suggests. Now multiply that by hundreds of thousands or even millions of gallons. This is where the business starts to get interesting. Suppose, purely as an illustrative example, a station sells 2 million gallons in a year and earns an average gross margin of 35 cents per gallon. That's £2,000 to $0.35 is $700,000 of gross fuel margin. $700,000 sounds pretty good, but that's not the same thing as $700,000 of profit. Take away labor. Take away insurance. Take away electricity. Take away maintenance. Take away payment processing costs. Take away property expenses. Take away taxes, repairs, licensing, security, accounting, and all the other costs that come with operating a physical retail location. Suddenly, that giant fuel number becomes much less impressive. And there's another problem. Gasoline prices move constantly. The station buys fuel at one price and sells it at another. If wholesale prices suddenly rise, the owner can't always immediately raise the price at the pump. Why? Because the station across the street is watching. So is the station down the road, and customers are extremely sensitive to price. NACS reported in 2025 that 72% of drivers said price was the most important factor when choosing where to buy fuel, and 69% said they would drive 5 minutes out of their way to save 5 cents per gallon. That changes everything. A gas station owner isn't simply asking, "What price should I charge?" They're asking, "What price can I charge without sending my customers somewhere else?" That's a completely different business problem, and it means location can become an economic weapon. A station on a major highway with thousands of cars passing every hour has an enormous potential customer base. A station hidden 3 blocks away may have cheaper rent, but if fewer drivers see it, that lower expense might not compensate for the lost volume. So the basic business model is incredibly simple. Customers need fuel. The station provides access to fuel. Fuel creates traffic. Traffic creates customers. And customers create opportunities to sell much more than fuel. This is where the gas station starts transforming into something else, a convenience store. Think about what happens after you park at the pump. Maybe you walk inside for a bottle of water, then you see coffee, maybe a breakfast sandwich, maybe chips, maybe candy, maybe an energy drink, maybe cigarettes or other regulated products. Maybe you buy a lottery ticket, and suddenly your $50 fuel purchase has turned into a $62 or $70 visit. The gas brought you there. The store monetizes the visit. And this is one of the most important ideas in the entire business. Fuel can be the traffic generator. The convenience store can be the profit engine. The numbers make that distinction very clear. NACS reported that convenience stores selling fuel generated about $476.3 billion in fuel sales in 2025. Fuel represented about 65% of sales dollars, but only about 38.8% of gross profit dollars. Think about what that means. Fuel generated the majority of the sales dollars, but it generated a much smaller share of the gross profit. That's the hidden economics. The product that dominates the parking lot isn't necessarily the product that creates the most economic value. And now you can understand why the inside of a gas station matters so much. A station might spend enormous amounts of money maintaining pumps, underground tanks, signs, canopies, parking areas, and fuel inventory. But those investments don't just support fuel sales. They create a destination where people repeatedly stop. And once the customer is inside, the economics can become much more attractive. Let's say a customer spends $45 on gasoline. Maybe the station earns a relatively small margin from that fuel. Then the customer walks inside and spends another $12. The store may have a higher gross margin on some of those products. The customer didn't make a separate trip to the convenience store. The gas station captured the sale because the customer was already there. That's incredibly powerful. You're not necessarily paying to acquire a new customer every time. The fuel itself is constantly bringing people through the door. And that is why the best gas stations aren't really thinking like oil companies. They're thinking like retailers. Now, there's another layer. The owner doesn't necessarily have to own the gasoline brand. Some stations are owned and operated by refiners, while others are independent businesses that purchase fuel from refiners and marketers for resale. That creates different business structures. One owner might operate under a major brand. Another might operate independently. Another might own the land and lease the station to an operator. Another might own multiple locations. And this is where real estate enters the picture. Because a gas station isn't just an inventory business, it can also be a real estate business. Think about the land. A successful station often sits on a highly visible corner with easy access, heavy traffic, and strong commercial demand. That property can have significant value independent of the fuel business. And this changes how an investor might think about the economics. Imagine two stations producing exactly the same operating profit. Station A sits on leased land. Station B owns the land. Their businesses might generate similar operating cash flow. But the owners have completely different assets. The owner of Station B may also be building equity in the underlying real estate. That's why asking, how much does a gas station make, isn't enough. You have to ask, who owns the land? Who owns the building? Who owns the equipment? Who controls the fuel supply? And how much debt is attached to the property? Those questions can completely change the investment. Now let's talk about what it takes to get into the business. A gas station isn't cheap to build. You're not just renting a small storefront and putting a cash register inside. There is land, there is construction, there are underground storage tanks, there are fuel dispensers, there are electrical systems, there is a canopy, there are signs, there are parking and traffic improvements, there is the convenience store itself. There are refrigeration systems, point-of-sale systems, security systems, and inventory. And there are regulatory and environmental requirements. Underground storage tanks are particularly important because gasoline is both valuable inventory and a potential environmental liability. The Environmental Protection Agency has extensive federal requirements governing underground storage tanks, including technical standards and leak prevention requirements. That means the fuel infrastructure isn't simply an asset. It's also a compliance responsibility. So imagine an investor looking at a gas station for sale. The asking price might seem reasonable, but the purchase price is only part of the equation. The investor has to investigate the property, the equipment, the tanks, the environmental history, the fuel contracts, the store's sales, the margins, the lease, the staffing, the debt, and the surrounding competition, because a beautiful-looking station can hide an ugly balance sheet, and a mediocre-looking station in an extraordinary location can be a fantastic business. This is why location is so important. The economics of gasoline are highly competitive. Customers can compare prices instantly. There may be multiple stations within a few minutes. And fuel is largely a standardized product. If one station charges substantially more than another for comparable gasoline, customers can simply drive away. So the retailer's advantage often comes from convenience, easy entrance, easy exit, visibility, traffic, clean facilities, fast service, good selection, and increasingly the ability to sell a lot of products during one short visit. Now imagine a normal year. A station has strong traffic, fuel volume is healthy. The convenience store sells thousands of products, labor costs are manageable. The owner has reasonable rent or owns the property. The business generates consistent cash flow. That's the good version. But what happens in a bad year? Suppose fuel prices spike rapidly. Wholesale gasoline becomes more expensive. The station hasn't adjusted its retail price yet. Its margin gets squeezed. At the same time, customers start shopping harder for cheaper fuel. Then interest rates rise. If the owner has a large loan, debt service becomes more expensive. Maybe a pump breaks. Maybe refrigeration equipment fails. Maybe the roof needs repairs. Maybe a major competitor opens nearby. Now several small problems can hit the same income statement at once. This is why cash flow matters more than revenue. A station selling $8 million of products isn't automatically healthier than a station selling $5 million. The real question is, how much cash remains after paying to keep the business alive? That's the number that pays the owner. That's the number that pays the debt. That's the number that can fund another location. And that's the number that determines whether the business can survive a bad year. Let's build a simplified example. Suppose our hypothetical station sells 2 million gallons annually. At an average retail price of $3.50, that's 2 million x $3.50 equals $7 million in fuel sales. Now add $2 million in convenience store sales. Total revenue becomes $9 million. That sounds enormous, but suppose fuel costs consume roughly $6.3 million of those sales, leaving $700,000 of gross fuel margin. Then imagine the store generates $2 million of sales at an illustrative 30% gross margin. That's another $600,000 of gross profit. Now total gross profit is roughly $1.3 million. Still sounds great, but the business hasn't paid all its operating expenses yet. Suppose labor, rent or property costs, utilities, insurance, maintenance, payment processing, administrative expenses, and other operating costs total $850,000. That leaves around $450,000 before considering certain additional items such as taxes, financing costs, depreciation, and owner-specific expenses. Suddenly, the $9 million business has become a business producing less than $500,000 of operating profit in our hypothetical example. That's the lesson. Revenue is the headline, margins are the story, cash flow is the reality, and leverage determines how much of that reality belongs to the owner. Now imagine the owner borrowed $4 million to acquire the property and business. If financing costs rise, a larger portion of that cash flow disappears before the owner gets paid. This is why debt can make a gas station extremely attractive when things are going well. Leverage allows an investor to control a large asset with less of their own capital, but leverage also makes the business less forgiving. If cash flow falls 30%, the bank doesn't necessarily reduce the loan payment by 30%. The debt still has to be paid. That's where a good business can become a dangerous investment, and this leads to one of the most important questions. How much fuel does a station need to sell just to survive? Let's simplify it. Suppose annual fixed operating costs are $600,000. Suppose the station earns an average of $0.35 of gross margin per gallon from fuel. Ignoring store profits for a moment, $600,000. $35, that's roughly 1.71 million gallons. So the station would need to sell about 1.7 million gallons just to cover those hypothetical fixed costs from fuel margin alone. But here's the interesting part. The convenience store changes the equation. If the store contributes $300,000 of gross profit toward those fixed costs, the remaining $300,000 would require only about 857,000 gallons at the same illustrative fuel margin. Suddenly, the store isn't an accessory to the gas station. It's part of the financial architecture. And this is the big reveal. The gas station isn't primarily selling gasoline. It's monetizing traffic. Gasoline is the reason customers need to stop. The convenience store is one of the ways the business captures more value from that stop. The real asset is the combination of location, traffic, customer frequency, retail space, fuel infrastructure, and real estate. Once you see that, a gas station starts looking completely different. It's a tiny transportation hub. It's a retail store. It's an inventory business. It's a real estate asset. And sometimes it's a highly leveraged investment, all operating under one roof. And the industry is enormous. ANAX estimates there are around 150,000 fueling outlets in the United States, with convenience stores selling roughly 80% of the motor fuel purchased in the country. As of December 2025, there were 122,620 convenience stores selling motor fuel. That scale tells you something. This business survives not because every gallon is wildly profitable. It survives because millions of transactions happen repeatedly. Volume matters, location matters, turnover matters, and small margins can become meaningful when repeated at enormous scale. But there's another risk that investors have to think about: the long-term shift in transportation. Electric vehicles don't necessarily destroy the convenience model overnight, but they can change the economics of the fuel component. If fewer customers need gasoline, stations may have to find new ways to monetize traffic. That could mean food, coffee, EV charging, car washes, prepared meals, delivery services, other retail categories. The exact strategy will vary by location, but the underlying business lesson remains the same. When the original reason customers came through the door changes, the business has to find another reason to capture their spending. And that is why some gas stations will struggle while others adapt. The strongest operators aren't necessarily the ones selling the most gasoline. They're the ones understanding what customers are actually buying. Sometimes they're buying fuel, sometimes they're buying convenience, sometimes they're buying breakfast on the way to work, sometimes they're buying a cold drink, sometimes they're buying time, and sometimes they're simply paying a premium because the station is in exactly the right place. That's what makes this business so interesting. On the surface, a gas station looks like a commodity business. The product is standardized. The price is displayed on a giant sign. The customer fills the tank and leaves. But underneath that simple transaction is an incredibly complicated money machine. Crude oil becomes gasoline. Gasoline becomes inventory. Inventory becomes traffic. Traffic becomes retail transactions. Retail transactions become gross profit. Gross profit pays employees, rent, maintenance, financing, taxes, and everything else. And whatever survives becomes the owner's return. So, is owning a gas station actually a good business? It can be, but it isn't the easy money machine many people imagine. The upside comes from volume, location, retail margins, real estate appreciation, operational efficiency, and potentially multiple revenue streams. The downside comes from thin fuel margins, expensive infrastructure, environmental liabilities, competition, debt, labor, maintenance, and changing transportation habits. And the biggest mistake would be looking only at the price of gasoline, because the price on the pump tells you almost nothing about how much the owner is actually making. The better question is, how many gallons move through this location? How much margin is left after buying the fuel? How much does the store sell? How profitable are those sales? Who owns the land? How much debt is attached to the property? What does it cost to operate? And how much cash remains after all of it? That's how you analyze the business, not by looking at the giant number on the sign, but by following the money underneath it, because the gas station people see from the road is only the surface. The real business is the flow of money happening underneath the pumps, and once you understand that, you realize something surprisingly simple. The gasoline gets the customer there. The business makes money from everything that happens after they arrive. If you enjoyed this breakdown, subscribe to Money Behind for more stories about how everyday businesses actually make their money. And let me know in the comments, would you actually invest in a gas station if you had the capital? Or does the risk look much bigger than you expected? Because the next time you see a gas station on the side of the road, you might not just see a place selling gasoline. You'll see a business model, and you'll know exactly where to look for the money.